Welcome to the program this week. Well, last week we put a few big name results through the Teaminvest test. This week, as reporting season continues and the small caps are in large part yet to report, we're going smaller. So with a $1 billion market cap cutoff, we're hunting for the small cap businesses where reporting season could uncover genuine value, perhaps it already has, or expose the dogs. We'll also answer a viewer question. Well, before we get into the stocks, let's just quickly talk strategy. Because what makes reporting season particularly interesting for a value investor looking at small caps, well, what is it? And what should you be looking for perhaps beyond the headline numbers? Andrew Coleman from Teaminvest is back. Nice to see you, Andrew.
Nice to be back.
And we're joined by Richard Hemming as a treat from Under the Radar Report. Nice to see you, Richard.
Glad to be here.
Look, just give us a little 60-second pitch for Under the Radar Report. What type of investors are you?
Well, we're cheap. We like value. Like that's what Andrew and I have in common. We don't like paying much. And the good thing about Under the Radar Report is we're very focused on small caps. So there's a never-ending never-ending plethora of companies that come across our ballot. So there's always stocks. It makes it very interesting. And I guess over the course of 15 years, we've proven our worth. We've picking some winners. Sure, we have the odd loser, but they've been well outweighed by the winners.
Nice. Look, well, we nailed it getting you in for today, so thank you for that. Maybe I'll start just with a question. Andrew, why do you think that reporting season can be especially valuable, I should say, for small cap investors?
Well, I think they're just not covered on shows like this in the same level of detail that the ASX 20 or ASX 50 or ASX 100 are. So, those investors who are interested in the smaller end of the market, whether they're using a research report like Under the Radar Report to get those ideas, or they're just, finding companies that they like on the ASX, this is your chance twice a year, in the half year and the full year, to really understand what's going on, because unfortunately, the AFR is unlikely to cover them. Ausbiz may, but there's just so many of them, right?
Yeah, it's true. All right. So Richard, what, if you can just give me briefly, what are the first things you look for when it comes to small cap reports?
Well, the first port of call is the balance sheet. I always look to see, what I'm looking for is really a margin of safety. So the balance sheet provides a margin of safety. The cash flow provides a margin of safety. The revenue line provides a margin of safety. And of course, the margins that they're able to get from those sales provides a margin of safety. Beyond that, you're looking for track record, if any. You're looking for founder management. So you've got a number of boxes you're trying to tick. Basically, some of it at the start has to revolve around credit sort of analysis, really just saying, if this happens, can this company kind of still survive? Because there are always bumps in the road. And you look at Fortescue, if you'd made some of the mistakes Fortescue have made, they'd be carted. It would not be around. But because Fortescue have such a strong core business, they're a survive. So small caps, you've really got to look at how they make money. How do they make money is such a simple question, but one in which Jeff Wilson, who used to mentor me, he always impressed on me, keep it simple, stupid. So
yes. Yeah.
How does this company make money? Do I understand how they make money?
And will they continue to make money?
Yeah, well, at the end of the day, as a shareholder, you are a part owner of the business, and you get your income, whether that is capital growth or dividends, through the long-term economic performance of that business's engine. So understanding what's going to drive that engine, what's going to make it accelerate, decelerate, that is critical, whether it's a small cap or a large cap. But I think Richard's point's very right, which is that in small cap land, mistakes can be more painful and correct actions can be more rewarding. If you're a company the size of BHP and you do something great, the odds are you may get 1 or 2% extra growth. It's hard to get a lot more on a company that scale. But if you're a company with a market cap of 100 million, well, you could triple or quadruple in size. And vice versa. If you're a company of 100 million market cap and you make a material blunder, you can't write off the kind of money that BHP has regularly done in the last 40, 50 years and smooth sailing. So from that point of view, I think small caps just really turbocharge the questions an investor should be asking. They're the same questions. It's just the stakes are higher, both the upside and the downside.
You agree?
Oh, well, this reporting season, we're seeing a lot of companies with, disparities within the sector, especially retail. So there are buying opportunities, but I think what this reporting season shows is what the price investors are prepared to pay. So what we're seeing is interest rates are, I think the consensus is now that they're higher for longer, whether for how long that's been the consensus. But now we're definitely seeing companies under a lot more pressure to show me, okay, you've done something for me in the past. What can you do for me tomorrow? So that is why this reporting season is so important, because it's no longer a case of a rising tide lifts all boats, especially in places like retail.
Yeah. Is there anything idiosyncratic about this result seasons for small caps that you think, you really need to be on alert for, paying attention to as a small cap investor particularly?
If I may say, just in general rather than small caps, we've talked about this a lot, this idea that the economy and the market are bifurcated. In the US, they call it a K-shape, but there are some companies and people doing incredibly well and others doing incredibly poorly. And I think you're seeing that more and more in the market and the results that are being released play out. Now, of course, that's incredibly fertile, happy ground for long-term, considered, researched investors, particularly value investors, but anyone doing kind of research, because as Richard said, when the tide is lifting all boats, putting in the effort to understand a company only gives you a very small excess return. Because sort of everything goes up today, 10, 12, whatever, you get a slightly bigger thing. But when you are in periods of dislocation, then it's important to understand where the water and the oil is, because that's where you're going to make outsized returns on getting it right. But perhaps more importantly for everyone watching at home, avoid the big blow-ups that are wrong. Buffett famously said there's 3 rules of investing. Rule 1, don't lose money. Rule 2, never forget rule 1. And when he was asked what was rule 3, he said you don't need it anymore. And I think that's the point, right? If in long-term value investing, your capital will continue to compound as long as the company continues to grow. If the company doesn't exist, that capital can't compound. If the company continues to shrink, it will compound in the wrong direction. These are the times when you can tell who's swimming naked, only when the tide goes out.
Mm-hmm. All right. So, Richard.
If there's an image we don't really want to go on.
Yeah. Well, I mean, you could throw me a Buffett quote if you like. But when it comes to, I guess, that fundamental view, how do your first rule of thumb for avoiding the losers? You admit everybody's had blow-ups, but where do you go in a result to make sure that you're avoiding those losers?
Well, I mean, like, I guess the first, probably the first place you look is the outlook. Like, the outlook is pretty much, like, we've seen some of these retailers do quite well over the year, but things have fallen off really in July, and if not before, and you've seen that fall off scare investors. So I guess it's a matter of just focusing in on why you're in that stock to start with, and then looking to hear, well, on the outlook front, does that validate the reason why I'm there? So retail's being very interesting. Like, we've seen JB Hi-Fi carted heavily. And this is one of the best run retailers, I think, in the history of Australia. And there's been a few of them. But like, not even JB Hi-Fi can control, the effect of 3 interest rate hikes. Whereas you've seen Myer, now they had a bad, they exhibited the same kind of decline, 5%, in 2 quarters in a row. But what you're seeing is that there's more value there. So whereas you're paying 22 times for a JB Hi-Fi, you're paying 5 times forecast for a Myer. And you're seeing some, new business that they bought from Premier. So you've got like something that's inside the tent. You've got a bit more substance to say the price. There's more, I guess, ballast for the price that I'm paying. So you can see that there's a different value proposition, but they're experiencing the same sort of pain of the discretionary spend falling.
Look, I was going to say value trap, Meyer, but what we're doing is we're chomping at the bit to start talking about stock specifics. So let's do it. Let's go head to head. So let's get to the stocks on the list then, shall we? Here with me in studio, as always, Andrew Coleman from Teaminvest and also Richard Hemming from Under the Radar Report. Gentlemen, you've been talking retail. So let's start with the result that we've already had come through in this reporting season, and that is Nick Scali. So is that looking like good value to you, or what did you make of the result?
Well, I think, in life you have people who are drowning and people who are swimming, and Nick Scali's in rough waters, and Nick Scali's a swimmer. And I think in the last result we saw, sales up 5%. So we saw a pretty good result with their gross profit margin up another percentage point over that. So we saw net profit up 10% to 80 million. And that was after, the costs of the UK. So we're seeing a stock that's paying a dividend while, they work very hard under the water. I'll use another metaphor, the swan. I mean, I can't get away from metaphors today, but basically you're seeing a founder-led management team working very hard to work an asset, and that asset is a new business offshore, but also the asset here, the core business is providing, doing the business is actually performing better, in terms of a comparison to their competitors. So, it might be a while before we see the benefits of the UK, but sometimes with these founder-led management, you just have to believe in them, and you just have to think they look a bit further out.
So you think for Nick Scali being down 6% over the past 5 days since it reported, roughly speaking, that it's looking like good value?
Oh, we think it's good value, because I think when some of these value stocks, right, it's not like suddenly they're going to just change and you're going to get a big spike, because you're buying them because the sentiment is necessarily uncertain. There is a lot of pain that's going to be felt through the wealth effect of housing prices coming off, and that will be reflected in their sales. There is no doubt that it's not easy times, but this is like the actual time when, as an investor, okay, you're not going to worry about 6%. What you're going to do is celebrate the fact that they're paying you some dividends, and that you can ride out this pain, and it's not really pain when you're getting 5.5% yield. So really that's what investing is about, is saying, I can tread water for a while because I have confidence in their long-term goals.
Well, Andrew, I've got to bring you in here because I believe we've spoken in the past many times about the pitfalls of Aussie companies going overseas. So is that a reason why you would steer clear of Nick Scali?
Yeah, it was interesting, actually. I was just having a look on Conscious Investor while Richard and you were talking, because we were very big believers and big investors in Nick Scali from about 2014 till August 2025, it looks like here on my notes. And that was really because if you look at the business, and I'll just pull up a couple of charts for you, the return on equity and return on capital of Nick Scali up until that period, so if you sort of where my cursor is now hovering left, are astronomical. That's north of 40%. That's the kind of thing you'd expect from a SaaS tech company, not a heavy retailer. And that's because effectively their customers are so excited to get a piece of Nick Scali furniture that they pay Nick Scali in advance before Nick Scali has to make the furniture. That 12-week delay that you wait for your sofa is effectively you cash flowing Nick Scali. As a result as well, earnings and sales rose, because when you've got wonderful return on equity, you've got lots of capital to reinvest to keep conquering your market. And so then the question, I suppose, is, and you've sort of hinted at it, why did we stop covering Nick Scali in the membership in around August 2025? And the answer, of course, is twofold. Firstly, the debt to equity in Nick Scali, or threefold actually, the debt to equity in Nick Scali had got a little bit too much for us. Now, to be fair to Nick Scali, that debt to equity of 125% that you're seeing there in red on my screen also includes their lease liabilities, which is the change in accounting standards. So perhaps you can excuse that and say, well, that's an accounting trick. But there were two other reasons. The first was that Anthony Scali and the Scali family started selling shares. Now, they had good reasons for it, But, people vote with their wallets. If they had believed that Nick Scali from here was likely to continue getting the growth that it had been over the last decade, one assumes the family wasn't selling. They'd be wanting to own more of the business rather than less. And so we've always found in our membership that insider selling is a very good predictor of future performance. And then thirdly, and perhaps most importantly, the risk profile changed. This was a business that dominated Australia, knew the culture really well here for furniture, and now they were making a big bet on buying a UK retailer in administration. Now, they bought cheap, big tick. It's an area they know, big tick. But operating a business in the United Kingdom from Australia with the time zone difference, the culture difference, just the whole way houses are built in the UK being different was always a tough ask. I think they've actually done very well with what they bought in terms of the fact that they seem to have reduced the losses and start to be potentially looking at profits. But that was always going to hammer the return on equity and the earnings of the business. And so, when you are presented with 3 potential risks triggering at once, you've got to ask the question, as a Teaminvest value investor, is there a better place for your money? So I don't think there's anything wrong with Nick Scali. I just think there are better places for your money than owning a retailer at that stage on a PE of about 25 or 30. It's come down since, perhaps it's more interesting now, but that was our rationale.
There you go. We're going head to head with companies that are below the 1 billion market cap, and we're talking about results. Now, obviously, a lot of the small caps, come to market a little bit later on in the piece. One of the companies that I thought might be interesting to talk to was Acrow Formworks. That's one that you follow, Richard, Acrow?
Yeah, I didn't follow it for a while. Like, we had a different analyst who covered it, and I'm sort of just getting up to speed on Acrow. But what I've been impressed with is how the business has different elements to it, and one isn't firing while the other one's firing. I was nervous about debt, but the debt situation has corrected itself through a capital raise. And I do like that they have a couple of bolt-ons businesses. But I think what's exciting about Acrow is what's happening in Queensland, and that is the Olympics. Because I know you're a sport lover too, Nadine. I'm sure you were following.
You know me.
Yeah, well, exactly. And Andrew, goes without saying. But I guess like they are in a very good position, like a number of other companies, to capitalize on this, and they have invested and I guess the construction division was substandard in its return, but part of that substandard or underperformance was because they were investing to make hay in the coming period. And I think that on the fundamentals, it looks quite good value. And I think, okay, maybe it's not going to shoot the lights out, but I think the management's got a good track record. It is quite a risky business, like being in construction. Costs are an issue, but I think that they've been through the tough times, and I can see that I like that's what makes this result very interesting for me, to see what they can do.
Yeah. So you'll be zeroing in on any commentary around, contracts being won in relation to those Olympics, or is it still too early for that?
Oh, no, I think we're at about that. You can notice on those investor calls, people are starting to get a bit impatient and to say, so what we want more information. So definitely investors are always impatient at the best of times, but definitely I guess we're getting to the point where we really want to see more visibility on FY27, which is when they said it was going to start kicking in.
Right.
So that's now.
Okay. So what would you look for in Acrow's results?
Yeah, look, I think if I can maybe just do a bit of a plug for Richard here. Companies like Acrow are the reason you need people who are prepared to do the work that Richard and his team do. So what do I mean by that? They are small caps that are growing quickly. I mean, Acrow's growing at sort of 30% per annum at the moment, if you can have a look at that in the earnings and sales chart. But they're in a difficult business and a difficult industry where understanding the true drivers, what are the moats, what are the risks, what's the strategy, what are management like, is absolutely critical for you as a potential investor to understand, is that growth rate going to continue for the next 5 years, in which case probably paying a PE of 11 at the moment sounds like a wonderful investment, or is the debt to equity that's quite high or something else about this business going to derail that growth story? That's why people like Richard, true deep analysts, and there are fewer and fewer of them in the market today, sadly, have such an important role. as a result, I'm not qualified to talk about Acro because the first time I'd ever actually heard of it was when you sent through the list for today. But what I will say is, as a general value investor comment, what you would note is you'd note that debt risk, which I believe Richard said that now.
Well, it was about
capital raise.
four times. It was getting a bit scary. But they always say, "Oh, we're within covenants," but I'm not so sure how.
Well, you're always within covenants until you're not, right? That's the problem.
You're always a bit skeptical when they have to say that. You think, "Oh,
Yeah.
But they did that capital raise, and I think their capex hump has receded. So they've spent a lot of money. So one of the things that you're looking for in companies is what's their capex going forward, because that really does affect their returns. And from what I can see, it's going to be a lot lower than what it was, the capital expenditure. So I can see that they're going to have tailwinds rather than headwinds.
Yeah, and so from that point of view, I mean, if you look at the numbers as we were just doing quickly, and it's not one we cover, so this is all just purely first glance, but the return on equity looks good, the return on capital looks good, despite being in construction. Stability's okay, high stability of sales, pretty good stability there of earnings at 72%. PE of 11, it's got all of the hallmarks of things you'd want to look for as a value investor. It's just been too small to be on our radar at Teaminvest. But then, if you subscribe to someone like Richard and you read their research, this could be a really good one. I just don't know enough to say
That's okay. And honest answers only, as I always say. So let's get to another small cap that has yet to report, and switching sectors completely. We'll go to Nanosonics, if you don't mind, gentlemen. So I know we're jumping around here a little bit, just in the interest of time, but what will you be looking for in Nanosonics? Because I feel like I've been talking about this company forever.
It had some swings and roundabouts.
Yeah.
Because it's like they had this great product, Trophon, that they've really milked and done a good job of. It's not the sexiest product in the world, like cleaning probes, but they've made it work in the US market. And they have like iterations of that product that they're selling. So they've managed to really squeeze more and more out of Trophon, but the excitement is with their sort of endoscope device, Chorus. So that has been where the real frustration is. Like, when are they going to release Chorus? Because it's really just as big a market, possibly high margin, because endoscopes are actually more, there's more to it in terms of cleaning those devices, so high margin, and really does open up a big market for them. So it's one I've bought a long time ago, then sold, and then I've bought again sort of at recent levels, and they've been very quiet. So that's why I put that one on as being really interested on what they're saying. It does make you nervous, like, because they earn so much money overseas, the dividends aren't in their lexicon. So that always makes me a bit more nervous. But this is a company with a very, very strong balance sheet. Very strong balance sheet. The Irish guy at the helm could talk forever. He's a good operator, but but it's going to be this is going to be a very interesting result to see. Okay, when are they going to introduce? When do they get? Because they have weasel words like we're part commercializing. I don't think that's the actual word that they use, but it's kind of like they're trying to say they're commercializing without properly commercializing. But it's really time for this company
now
to start rolling. Not necessarily now or never, because they do have that cash flow from Trophon. So, they are, but definitely disappointment will be reflected in the share price, Nadine.
What do you make of Nanosonics, Andrew?
Yeah, I mean, we covered it on a call a few times. It's just a company that doesn't have enough stability for us. So, they've clearly got a wonderful one product and a lot of other things that may happen, but as a result, they're just not able to deliver stable growing earnings or stable return on equity. If you have a look at that return on equity and return on capital chart, it's a bit under 10% at the moment, so it's nothing to write home about. But the thing I wanted to just bring your attention to is a well-run business tends to have flat or slightly increasing return on equity and return on capital. It never looks like the nice escalator that you get in earnings, because you don't get percentage changes in return on equity. But a business with strong moat should be able to generate roughly the same marginal return on every dollar they invest. The reason that businesses can't do that is usually because they either have weak moats So they're constantly having to invest in the hope of getting something, or they've got risks on the horizon or management challenges. And Nanosonics has always struck me as one of those where, there's just too much in the way that can impact their moats or their risks to be the kind of stable investment that we prefer at Teaminvest. And then the fact that it's been a market darling for forever, and it's on a PE of 56, which amusingly is in the bottom quartile of its trading history. But, a PE of 56 is 3 times the long-term market average. So to get a return from here, you'd have to triple the earnings just to get back to even in a long-term market perspective. And I just don't think that's a risk that you'd want to take as a long-term value investor. And certainly we've never bothered at Teaminvest. You can see it's appeared a grand total of 0 times in our meetings.
All right. I know that I said that we were going to stick to the smaller end of the market, sub 1 billion market cap, but we couldn't have Andrew here on a week that CSL reports and not ask for at least an initial impression. I don't know if you've done your deep dive yet, Andrew, but for everyone out there, what did you make of the CSL result? The share price on the day absolutely soared.
Yeah, I think it's business as usual, and I don't want to say those 4 awful words of "we told you so," but we told you so. I mean, look, this is nothing that we've done particularly successfully as Andrew Coleman or anyone at Teaminvest. The company has told everyone for the last 6 months that revenue was going to be flat, earnings were going to be their second highest in history, but just not quite as good as last year. In fact, they were forecasting between sort of 1% and 3% down, and they came in 2% down. So, there is nothing that CSL said that a rational, considered researched investor should have been shocked about, other than for some weird reason, market, and in particular, a lot of big market analysts, not Richard, but others at places like Macquarie, managed to get themselves in knots explaining how, despite what the company said, CSL was broken. Who cares that they've got moats that are some of the strongest in the industry around both their patents and their collection sectors and all the rest of it. CSL was a broken business and managed to convince everyone that what was a market darling and at a stupidly high PE on a price of $300 was worth sub $90. It was never worth 300. It was never worth 90. This is what the animal spirits of the market does. Now, we have a huge advantage as Teaminvest, I think, over most in this case. And it's really simple. It's number one, we look at the data. We don't get caught up in the emotion because we're long-term value investors. So we say, well, who cares about the share price on the day or on the week or on the month? What is the actual data? What are the facts? And then the second thing is we have 700 high net worth, intelligent people looking at all of these companies as our members, asking those questions, saying, hang on a minute, John Smith analyst has said this thing is broken, but the company's saying it's going to be their second highest year on record. And so that wisdom of the crowd gives us a material edge far greater than I think most people realize in the short run. Now, will CSL get back to $300? No idea. But we get so caught up sometimes as investors on this sort of Chicken Little approach where the sky is falling, or alternatively, everything is going well and nothing can ever go badly, and we forget that the world doesn't work like that. CSL is just another one of the many litanies of examples where if you suspend your disbelief, you get caught up in emotion and you don't look at the facts, you lose your shirt. And if you can hold your nerve through that by being rational and considered, you make a hell of a lot of money. What's it up now, 70% in the last 3 months?
It's on a run, Andrew. It's on a run. All right. Richard, I don't want to leave you out. Any burning thoughts on CSL?
I think basically what Andrew said was right. Like there was no real difference from what they said in May outside of revenue is slightly better. And I think this new guy is doing what McKinsey should have done. So they're just, sort of slimlining the business to a degree. They've written off those Vifor and the Securus is just on the back burner, but the rate of growth is not plummeting like it was, so it's kind of stabilized a bit. So things have stabilized, and sometimes it comes back to what we said at the start of the show. It's what you're paying, it's what the expectations are. So people, all they had to do was reassure investors essentially that what they said 6 months ago was okay, right, and we're doing a little bit better. Whereas JB Hi-Fi, well, they are a well-performed management, but their controllables are a lot less. Like they can't, they like we've seen like right now people really are scared of the discretionary spend in the market. Whereas CSL, like their blood products, well, people are going to need them, right? Rain, hail, or shine. So there's a lot more substance there for what the company can do. Whereas it doesn't matter how good your management is, if people aren't opening their wallets, they're not opening their wallets. Mm-hmm. So that's what I think we're seeing partly in this season is the price of stocks, but also how vulnerable are you to the economic forces. And that's what's scary at the moment.
And Benjamin Graham said it so well 100 years ago, right? In the short run, the market is a voting mechanism. And in the long run, it's a weighing mechanism. And CSL and companies like CSL, it doesn't have to just be CSL, but we're talking about them, are very heavy companies. They are strategically strong. They have big moats. They have controllable risks, and they print cash flow. And if you have a look at, I've just shown it up again because it's my favorite chart in relation to CSL. This is the earnings per share and sales per share of CSL for the last 10 years. Point to me the broken business. On the other hand, we've just been talking about some other companies, not so much on this one, but on the call episodes that are market darlings. And I'll give you a great example of one. This is Tesla, one of the most valuable companies in the world, in theory, by market cap. Where's the weight? This is market voting, not weighing. The weighing of this business, it's getting lighter and lighter every year, but its market cap keeps rising. That can go on for a while, but in the end, the heaviness will mount.
All right, guys, great chat. Going head to head on a whole range of companies. I'm always overly ambitious. I gave these guys a long list. I'm really sorry if you did all your prep, Richard. We'll get you back another time. Thank you so much for joining us today. Richard Hemming from Under the Radar Report. Andrew Coleman from Teaminvest is sticking around to answer your question, of course, because you asked. Let's get straight to our viewer question. If you have a question for the team, it's wealthy@ausbiz.com.au. So this is following on from last week's episode. And Sid writes, I'm thinking of the Credit Corp example from last week. Is a company's ability to learn from its mistakes and reinvest that knowledge a competitive advantage in and of itself? So I believe that's referring to the fact that, Credit Corp has made mistakes in the past. But it appears, at least to those believers, and I know that encompasses some of those, at least at Teaminvest, that it's learned its lesson. Is that a strength?
Yeah, I think probably from a Teaminvest membership point of view, Credit Corp's sort of one of those borderline ones that sometimes is in, sometimes is out, and it really depends on the people's circle of competence and their view on it. So, but I think the meat of the question was a really good one, which is that ability to learn from your mistakes or your successes a competitive advantage? And I think the funny thing about that, I was thinking about it a lot when you sent that question through, it shouldn't be, because those mistakes are public and everyone should be able to learn from them. But we're human. How many of us ever truly, really do internalize the lessons and get better at it? That's what makes a wonderful investor, that you can learn from your successes and mistakes and hopefully repeat the successes and avoid the mistakes. And it's what makes a wonderful business person. In my book that we released a few months ago, I talked about the fact that growth is not the goal, compounding is. Whether that's running a business or making an investment, your goal shouldn't be to try and get all of your decisions right this year. The goal should be, how do you find decisions that you can repeat again and again and again, that each time earn you more than the time before? And that's really what we talk about with learning. It's one of the three things we all have access to that compound. I talk about this a lot with our team in the office, but as humans, we have access to three things that compound. The first is money, and we talk about that on this show. It's investing. Money compounds. The second is culture. We share our culture, we get culture from others, that compounds. That's a form of compounding. We can help others get better at doing things or weaker. And then the third is our knowledge. And our knowledge compounds because when we talk to other people and we do more research, it builds on the knowledge we had. But the big advantage knowledge has over the other two is it only compounds in one direction. Money can compound downwards. You can get things wrong. Yeah. Culture can compound down. Knowledge can't. So I think, yes, it is a competitive advantage, probably because most people don't learn from it. And I'll wrap it up with, there's a lovely saying, I'm going to attribute it to Mark Twain, but it may not be. I need to check that. But he said that, every 10 years he looked back and was embarrassed at the person he was. And we should be the same as investors about our own investing decisions and as businesses around how we run them. because then we'll get better.
Nice. Andrew Coleman, Teaminvest. Thank you. Thank you for your questions. Very thoughtful, Sid. wealthy@ausbiz.com.au. We look forward to seeing you next week.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.